Coming up in today's show, stocks start the week off a bit mixed. While some say this is a once-in-a-generation buying opportunity, while others say the market could still fall 60%. A look at Warren Buffett's latest moves, an update on the bond market, along with the oil market, and a little bit about me and my latest investment I've just made. Hey, what's up guys? I hope you're all doing well and had a great weekend. Welcome back to the Click Capital Daily Market Show. My name's Jared, and just before we get into the daily show as usual, I thought I'd just take a quick few minutes to introduce myself and give you a bit of background about me. As I know a lot of you guys tune in every day, and you may be wondering who is behind the mic, and I've had a few people interested and reach out wanting to know a bit more about me, so I thought I'd just give a proper introduction and tell you a bit about how I got to this point now. And also just want to touch on a bit about a special presentation I'm making available on Wednesday night, where I do a deep dive into my latest investment in my long-term personal portfolio. But first, let me just introduce myself to you. And so my name's Jared, that's me there in my trading office. And so I grew up in Australia, and I was fortunate enough to have a good family that sent me to a good school. And I was lucky because the school I went to really placed a lot of focus on technology. And so it was very innovative. Back in the mid-90s, every student, including myself, was given a laptop, and so I just happened to grow up with computers at kind of the beginning of the internet. And after leaving school, I had a bit of a gap year or two before I became a Subway franchisee. And with the help of my parents, we actually opened a Subway store, in which I worked in for a while before quickly discovering that although I liked the Subway business, making sandwiches wasn't for me in the long term. So I went back to school and studied a diploma of financial services, as I had already developed an interest in investing and trading. And then after completing that, I was hired straight away by Australia's biggest and leading investment bank, Macquarie Bank. And I started off at the bottom of the ladder there in the mailroom, then running checks around the city, which was pretty cool for a guy in his early 20s. I was carrying around millions of dollars in my pocket and going around and meeting with all the different brokers and advisors, and then moved my way up into the cash management department, where I was looking after accounts for high net worth individuals and seeing how they move money around, and learnt quite a lot. So I worked there for a couple of years. Then I resigned just before the global financial crisis in 2008 and went out to work on my own. And that's what I've been doing for the last 15 years. I've been trading and investing for myself and running various online businesses, in which I still do today, with my main focus being on Click Capital, where I share my private custom indicators, and I also run a daily markets analysis show on YouTube, which I post every market day after close. And so whilst living in Australia, I always used to come over to Queenstown, New Zealand for snowboarding trips with my mates, and I love the place so much I actually moved there to live in 2017, and that's where I currently reside as well. I do often travel back to Australia and to the States and other parts of the world, and like I said, I've got customers from all around the world, but I do consider Queenstown, New Zealand as kind of my base camp, and I really enjoy the outdoor lifestyle that we've got down here, including hiking, camping and golf, amongst other things. Okay, so that was just a bit about me. Now I want to let you know about something I've been working on for a few weeks. That's a special presentation I've made, which will be available for purchase on Wednesday night. And in it, I do a deep dive into a small stock I've recently invested 12% of my long-term portfolio in. I'm really excited about it. I think it's my best pick all year. And it's a micro-cap stock currently under 300 million in market cap. It's already very profitable, well positioned in a high growth industry, pays a healthy dividend yield above 10% with quarterly dividend payments, has a very strong balance sheet with a net cash position and almost no debt. Management is very competent and have millions of dollars invested in the stock themselves. They also think the stock is undervalued, that's why they're buying back stock, and it's currently priced under $15 a share. However, according to my calculations, I think it's worth closer to $50 a share, and there's a few catalysts in the stock and industry which I think could send shares to $50 potentially in the next 1 to 2 years. And so what I'm offering this Wednesday night is a 45-minute special presentation video, which includes a 27 slide deck plus accompanying research material, where I do a deep dive into the industry, the business, the management, the balance sheet, financials, the valuation, risks, and technical analysis. And I'll share with you my investment objectives and plan for the stock. I'm only charging a one-time fee of $59 for this special presentation, and included with that will be regular updates from me, as I'll keep you updated on what's going on in the stock, the industry, and my investment in it. Whenever I do any further buys or sells, I'll email you and let you know. So I'm very excited about this. This is my first special presentation, and like I said, I've put a lot of work into it over the last couple of weeks. I think you're going to find a lot of value in it, and so stay tuned into that one, as that'll be available to purchase on Wednesday night, and I'll let you know through the regular daily show that you're watching now how you can do that. Okay, so just moving on back into the regular show, and just looking at the heat map to start the week off here. Once again, it's a tale of two markets. Mega cap tech leading the way today, continuing to trade like its own asset class, different from the rest of the market. And we did see a bit of weak breadth, especially in the smaller caps and in some other sectors like REITs and energy. And there was a little bit of a defensive rotation into some staples and healthcare names today, and a few isolated pops and drops as we get through the back end of Q3 earnings season. And we are getting into that bullish seasonal period. November is usually a really good month for the stock market, especially after selling off in October in an otherwise up year. Looking back in history, in previous instances when the S&P declined in October, stocks gained a median 5.3% over the next 6 months. And it's not unusual going into the new year to get a bit of a Santa Claus rally. And we all know this year the story's been mega cap tech, really outperforming the rest of the market as a group. However, some are saying now it's the time for the S&P 500's other 493 stocks to perform. And with the Magnificent 7 trading at an average PE ratio of 41, compared to the equal-weighted S&P 500's PE of 15, this research analyst is saying such narrow leadership seems totally unjustified, and their extreme valuations suggest a once-in-a-generation opportunity in virtually anything other than those 7 stocks. And it's true, and that's why I think of this current market as like a case of tale of two markets, as small caps are really cheap relative to the S&P 500. In fact, the cheapest they've been for over 20 years, just after the tech bubble in 2000. And as we can see in this chart here, small caps would often start to outperform large caps around the time when unemployment started to rise, as they tended to bake in recession ahead of time. So we can see in the dark blue line here, that's the Russell 2000 relative to the S&P 500. So small caps versus large caps. And basically small caps have been underperforming large caps for over a decade now. However, looking at the light blue line, which is the unemployment rate, you can see small caps actually start to outperform large caps when the unemployment rate rises, and we've seen that time and time again. And there's a look at a clean monthly chart of the spread between the Russell 2000 and the S&P 500. We can see that's really come off hard the last couple of years. And just zooming out, that spread actually peaked out back in April 2011. And so we can see in the first decade of the millennium, small caps significantly outperformed large caps. Kind of went sideways for about 10 years. Then the last 8 years has come off a lot. And so if the unemployment level is going to keep rising, then small caps could very well be close to a bottom relative to large caps and outperform over the coming years. From these really depressed levels, in which you can still find a lot of healthy small caps with a PE under 10 and long track records of paying healthy dividends as well. And on the other hand, you can still find large tech stocks struggling with profitability, still trading at price to sales over 10, and if they are making money with PE still over 50. So you can't just look at the stock market through one lens. There's a lot of different categories underneath the surface. And whilst I think the stock market as a whole, led by the big indices S&P 500 and NASDAQ, do have some significant risks over the next year, and with, like I said, still a lot of highly valued stocks, there are some bargains out there for the long-term investor if they're willing to stomach a few months of volatility and potentially scale into long-term investments at lower levels as well. And we can also see that dynamic play out in dividend stocks in addition to small caps. In this chart here of 20-year rolling annualized outperformance of the top quintile of stocks by dividend yield minus stocks paying no dividends. And this is going back to 1947. So when we see this green line increase, that's dividend-paying stocks outperforming. And down here where we are now, that's non-paying dividend stocks winning. And so in recent times, it's been the boldest outperformance by stocks who pay a 0% dividend in almost 100 years. And like it says here, if we do get a mean reversion on this dynamic, you can say goodnight to the growth at any price framework that is so commonly embraced and that's been a strong theme in the market throughout recent years. And so basically dividend-paying stocks are really cheap relative to non-payers. And that's why we've got some analysts like Richard Bernstein saying the market's forgotten stocks could lead to a once-in-a-generation buying opportunity. And that's because profits are about to accelerate for companies throughout the stock market, and that could usher in a decade of sagging returns for market leaders and huge gains for others. So basically flipping the scenario we've been in the last couple of years. And it's true, the exposure, traction and momentum the Magnificent 7 have got don't really align with their earnings growth, because of the 130 US companies that saw at least 25% earnings growth in the 12 months through October 15, Amazon was the only Magnificent 7 stock represented. You can see all these other stocks that have grown earnings at least 25%. And basically I think so many people are invested in those top 7 stocks because they do have so much exposure, especially in the media. Everyone's always talking about them. And on all these commission-free trading apps that have become really popular around the world, everyone just logs on and buys Apple, Google, Tesla and NVDA. And I think that's helped to keep their valuations persistently high. But let's see if that holds up over the coming years. Because on the other side of the coin, we've got long-time strategists John Hussman dismissing the idea that Richard Bernstein says is a generational buying opportunity. And John points to the historical S&P 500 returns. And he's even warning that the benchmark could fall by 60% to 1,600 points on the S&P. And John has been a bit of a persistent bear over the last couple of years, but he does have some good data to back up his calls. And that's by measuring the valuation of the stock market versus the bond market, then modeling data going back almost 100 years to estimate the forward 12-year S&P 500 total return in excess of treasury bonds. Where we are now has almost the worst forecast ever, coming in at a negative 7.4%. In other words, treasury bonds are expected to outperform stocks over the coming 12 years. But we've got to remember, that's based on the highly skewed S&P 500 index, with heavy weightings coming from those magnificent 7 stocks. So large caps could very well underperform a lot over the coming decade, where small caps could actually outperform. And that's something I believe in and am positioned in my own portfolios myself. We've also got the best stock investor of all time, Warren Buffett, holding a record pile of cash, $157 billion. And he was a net seller of more than $5 billion worth of stocks in the latest quarter. As we just got Berkshire Hathaway's latest quarterly report, that's the 4th consecutive quarter he's been a net seller of shares. And we can see here in this chart of Berkshire Hathaway's cash pile. And in previous instances, like in the late 90s, he was raising cash. And then going into the mid-2000s, 2007, he was raising cash as well. And then in late 2008, early 2009, he put a lot of that cash back to work near the bottom of the stock market. He was buying a lot of stocks back then. Then pretty much this entire bull market since then, he's been significantly increasing his cash position. It's dropped a few times as he's made some acquisitions. But here it is now, currently at a record $157 billion. And like he's been saying for a while, his elephant gun is locked and loaded, ready for a big acquisition, which he doesn't see available at the moment. And he's actually been moving a lot of his cash into short-term treasuries, been able to earn above 5% now. He has very little exposure to long-dated treasuries and interest rate risk. He's keeping the vast majority of his treasury in short durations. And so he's ready to buy whenever we get the next big dip in the stock market, recession, or some other crisis. Nobody is better prepared for that than Warren Buffett and Berkshire Hathaway. And there's a look at the daily chart of Berkshire Hathaway. After reporting earnings on Friday, coming in a bit better than expected, same with revenue. And Berkshire currently has a market cap of $756 billion. That's above Tesla. And Berkshire now actually has more cash than the total market cap of Disney at $153 billion. And we'll get to hear earnings from them on Wednesday. And they've been struggling for a bit now. Bob Iger's come back to the helm and has been trying to turn things around. So we'll see how they go on Wednesday. So we had a really good stock market rally last week, with yields pulling back quite a bit as we got some softer economic data. Jobs report on Friday came in a lot weaker than expected. The dollar pulled back, along with oil as well, and corporate earnings continuing to hold up pretty good. We got a little bit of an uptick in treasury yields today, as some saying that big pullback in long-dated yields last week could just be a bit of a short covering as opposed to a new trend. But the short end of the bond market called out Jay Powell's bluff that he is indeed on hold and the Fed has likely finished hiking rates. And he actually said, with financial conditions, we're looking for persistent changes that are material. Longer-term rates that have moved up, they can't simply be a reflection of expected policy moves from us. So maybe trying to separate himself a bit from what's going on in the 10 and 30 year that is likely caused by the federal government and not the Federal Reserve, as the Treasury keeps issuing more and more bonds at these record rates, leading to concerns from the 2 biggest buyers of treasuries, China and Japan, which have been reducing their purchases, and we're already seeing signs of weak demand in US Treasury auctions. And the fact that there may be more wars on the horizon could mean the US government has to issue even more debt in coming years. And we can see in this chart here of expected Treasury issuance, with 2023 as a year coming in at $3.3 trillion. That's increasing the federal debt by 10% in just 1 year. And then the projections are for next year, the Treasury is going to issue $4.6 trillion in new debt to the bond market. So that's a lot of supply coming on. And that's keeping upward pressure on long-dated bonds. Unless we get a sharp recession, which will overwhelm that in the short to medium term, looking out the medium to long term, long-dated yields in the US are set to remain higher than usual because of this record issuance from the US Treasury and the pullback in the 3 biggest buyers of treasuries over the last 15 years. The Fed with quantitative tightening, China with their pursuit of de-dollarization in tandem with Russia, and Japan with allowing their long-dated yields to rise above previous hardline limits. That too is all upward pressure on long-dated yields. And we can see why big investors like Buffett don't want exposure there. They'd rather stay in the shorter durations that will benefit much more from the Fed cutting rates, along with having near-dated liquidity to take advantage of any opportune prices. Moving on from bonds to commodities, we saw the price of oil hold today after 2 of the world's largest exporters, Russia and Saudi Arabia, said they would stick to their additional voluntary production cuts until the end of the year. It's not a huge surprise, but it does keep supply tight, and the market will just be waiting to see whether they extend those cuts going into next year, and that'll be an influential factor in the price of crude and the effects that has on consumer spending and inflation. But for now, price is quite subdued at $81 a barrel. I think the Saudis and the Russians would probably want it more closer to $85, maybe $90 a barrel. There has been a bit of a pullback in demand and increase in supplies due to the high price of gas. We do have some more support right around these August lows, about $77.50, and I would be surprised if that didn't hold because we still have risks in the Middle East. And if we go back down there, we're likely to hear new production cuts from the Saudis and Russians. The Biden administration still has to refill the Strategic Petroleum Reserve. However, countering that, we do still have weakness in major economies, China and Europe. And if we do get a recession in the US, that'll add downside pressure to oil as well. Just moving on to economic data. It is a pretty light week on the news front. Don't have a whole lot of important things coming out. It was more last week, that was the big one. We've got Australia's central bank deciding on their interest rate in a couple of hours. With growing expectations, they're going to increase to 4.35% on the back of some hot inflation reads. We've got a few Fed speakers coming out tomorrow, along with some inflation and retail data from the Eurozone on Wednesday. We'll get to hear from Jay Powell on Wednesday morning as well. Some inflation data out of China, the usual weekly jobless claims Thursday, and finishing out the week with a bit of GDP data from United Kingdom and some consumer sentiment data as well. Slight increase in the probabilities from Fed fund futures. The Fed will hike on January, but still very low at 16%. The market's pretty much saying the Fed is done, and they're actually expecting them to cut rates come May, as the bond market is forecasting a recession by the middle of next year. Stock market still not all that excited here with the fear and greed index at 41. And we actually saw a large spike on Friday on the amount of corporate insiders selling stock, coming in at 195 sales versus 67 purchases. And just looking at my custom institutional buying percentage indicator, it's only slightly bullish at 55.8%. Once that goes below 55%, they'll be back in the neutral zone. And the S&P 500 oscillator got into that overbought zone on Friday, and it's just pulled back a little bit to 55.7 here. And we can see the market calling up a little bit today. A really small, tight range doji candle, stalling out a little bit just below this resistance level at 43.80. But stick with me to the end of this video, and I'll come back to the main indices as I normally do. Just going through the rest of financial markets. Looking at international stock indices, was a little bit mixed to start the week off. No real big moves there, all kind of just moving sideways. Just see a little bit of a pop in the VIX 9-day to 14.5, but we've still got the main VIX really low, under 15. It's got absolutely crushed last week. The Friday before, we got up to 22, and with that bounce in the markets, volatility's just come right down. Still got the volatility risk premium right at flat. Implied volatility's about the same as realized. There's oil volatility pulling back as well. And it was a quiet day to start. The weekend options, only 33 million contracts traded after we had a huge Friday. Once again, a little bit more calls, 52%, and a little bit of a pullback in breadth today. Still elevated there in the short term, 68% of stocks above the 20-day average, but still more stocks than not below the long-term 200-day average. And breadth as measured by new highs versus new lows. A little bit neutral and bullish today, 28 to 13 on the NYSE, and 28 new highs versus 26 new lows on the Nasdaq. There's a look at the Russell versus S&P 500 daily chart. Fell a bit today as small caps underperformed, but once again they're trying to put in a bottom here on a bit of a bullish divergence on my DSI and hidden divergence indicators. So we'll keep an eye on this spread as small caps are cheap versus large caps. There's inflation expectations back above the 50-day, and there's that little pop we got today in the 2-year yield back up to 4.94%, and a little bit less so in the long-dated durations. Got the 10-year at 4.64 and TLT falling almost 1%. Now just sitting slightly above its 50-day. Now a lot of people are hoping this is the bottom. There's a dollar index just sitting a bit above 105, and Bitcoin just keeps consolidating in this big resistance zone at 35,000. Little pop up in commodities, but pull back in gold. That too is stolen at a big resistance zone, $2,000 an ounce. Got agricultural commodities breaking out, coming up into a big resistance zone. And over to stock sectors, a lot of red out there. And some of those sectors we had big jumps in on Friday. The beaten down sectors came off again today with home builders down 1.3%, biotech down 2.2%, REITs down 1.3%, and airline jets down 1.6%. So still quite a bit of volatility in those sectors and yield sensitive sectors. Mega cap tech helped the tech indices finish the day higher. And there's that little bit of defensive rotation with healthcare and consumer staple stocks finishing up a little higher, and utilities just kind of holding ground there. There's a look at the price action of the world's biggest shipper, Maersk, which got hammered 17% on Friday after they announced plans to lay off staff. And we're seeing a lot of that in the transportation industry, trucking companies and such, really pulling back a lot in recent months. And we can see that here in this monthly line chart of truck sales, which actually peaked out in May at 565,000, and recently October just dropped down to 475,000. That can be a bit of a leading economic indicator, the amount of trucks being purchased. And just moving through to the big guys, there's Apple having a good day, up 1.46%, holding on to its earnings gains. There's Microsoft just a few points off all-time highs. Google looking to reclaim its earnings gap drop. Nvidia now back above 450. Amazon coming back up to highs, and Tesla a bit weaker. Was mostly down across the meme space, and a few drops on the other stocks we follow. General Motors, Walgreens, Macy's, and the telecoms just off slightly as well, along with the continued volatility in those regional banks and just a bit of a soft pullback in the larger players like Schwab. Okay, back to the main US indices to summarize. It was a very narrow trading range day to start the week. Like I said, we don't have a lot of economic data coming out this week, getting through the back end of Q3 earnings season. We are still in that bullish seasonal period for stocks. Earnings been holding up. Market's getting excited that the Fed is done, yields pulled back, oil is soft, so definitely reason for the bulls to be excited here. Technically speaking, we could still be in this downtrend, started from the 27th of July. Got a bit of a trend line overhead here, which coincides with that resistance from mid-October. That's around 4,400 on the S&P 500, which I think the market has a chance at stalling out this week, and maybe we roll over again. We can see that in the equal weight S&P 500, which already started the week down. There's the Dow Jones and the Russell 2000 finishing down 1.2%. There's the Mega Cap 8 coming back up to highs, trading like it's completely own asset category, as it has done all year. And this is one of the most interesting dynamics I've seen in my trading career. These pack of 8 stocks just outperforming the rest of the market so significantly and really trading on their own, and just be interesting to see how much longer this dynamic goes on for. But that's it for this Monday. Thanks very much for tuning in to Click Capital. Appreciate all your support of this channel, and I look forward to giving you the opportunity to get my special presentation on Wednesday night, where I do a 45-minute deep dive into a microcap stock I've recently invested 12% of my long-term portfolio in, and I think it's significantly undervalued, pays a really high dividend yield, management invested, got everything going for it. I'm really excited about it. So come back again to Click Capital channel on Wednesday to learn how you can get access to that. Alright guys, that's all for now. I'll see you again tomorrow afternoon. Cheers.